You know that feeling, right? Walking out of the grocery store, maybe?
Mm.
Or when you fill up the car?
Oh, yeah. That sticker shock.
Exactly. It's that feeling that your money, well, it just doesn't stretch as far as it used to, and that's inflation, sort of quietly eating away at your savings.
It's a big concern for a lot of people.
It really is. And it makes you ask, how do you protect yourself? What tools are actually out there? I mean, things specifically designed to fight back against rising prices.
Well, that's what we're digging into today.
We are. We're doing a deep dive into one investment that keeps popping up when people talk inflation protection. Treasury Inflation Protected Securities, TIPS.
Right, TIPS. But not just the bonds themselves.
No, we're going further. We're looking at the really accessible way most people encounter them now through exchange-traded funds, TIPS, ETFs.
Yeah, and our dive today, it's based on a pretty interesting mix of stuff. We've looked at, detailed discussions from online investment forums, real people talking about this. Then there's the official government explanations, straight from the source, on how these things actually work.
Okay.
And, of course, insights from financial industry publications looking at ETFs, how they're built, and some, surprisingly tricky tax issues that come up.
It's quite a range of material. So our mission today, our goal, is pretty clear. We want to unpack exactly what TIPS are, what TIPS ETFs are.
Get beyond just the definition.
Yeah. Understand how they actually aim to protect you from inflation. Then weigh the pros and cons buying individual TIPS versus the convenience of an ETF.
And the potential downsides, too.
Definitely. We need to look at the risks, the unexpected bits, like how did they really perform when inflation was sky high recently? That's a big one.
It is, and the tax stuff you mentioned.
Yes, some fascinating tax details in the sources. Ultimately, we want to arm you, the listener, with the knowledge to decide if TIPS ETFs might, fit into your own financial strategy.
Sounds good. Okay, let's dive in. Where do we start?
Let's start right at the core. What is a TIPS bond, fundamentally?
Okay, so think of it as a special kind of U.S. government bond. That's the baseline. It's backed by the full faith and credit of the U.S. Treasury.
Right. So generally considered very safe in terms of default risk. Like the government isn't likely to just not pay you back.
Exactly. Extremely low credit risk. That's the government bond part.
But the name, inflation protected. That's the hook. What's the magic trick? What's their superpower?
Their superpower, the thing that makes them different, is they're indexed to inflation, and not just like loosely correlated. Their actual core value, the principal amount of the bond, is designed to adjust based on changes in the consumer price index, the CPI.
Okay, wait. So the CPI, which measures general price levels, goes up. The actual face value of my bond goes up too.
That's precisely it. Your $1,000 bond isn't stuck at $1,000. If inflation pushes the CPI up 2%, the principal adjusts, maybe to $1,020. If it goes up again, it adjusts again. It follows the CPI.
Huh. And I guess the flip side is true. If we had deflation, prices going down, the principal could adjust downwards.
It could, yes. It follows the CPI movements, up or down.
That mechanism is really interesting. Now, they pay interest too, right? Like regular bonds? How does that work with this moving principal?
They do pay interest, usually twice a year, semi-annually, but here's the key difference. The interest rate itself is fixed set when the bond is first auctioned, but that fixed rate is applied to the adjusted principal value.
Ah, okay, got it.
Yeah.
So if my bond started at $1,000 with, say, a 1% interest rate,
Right.
and inflation bumps the principal up to $1,050, my next interest payment isn't 1% of the original $1,000.
Nope. It's 1% of the new adjusted principal, $1,050 in your example.
So the actual dollar amount of the interest payment goes up too, potentially keeping pace with inflation.
That's the idea. Both the underlying value and the income stream have this mechanism built in to adjust for inflation.
Okay, but what about that deflation scenario?
Yeah.
If the CPI goes down and the principal value drops below my initial $1,000, do I lose money if I hold it till the end?
Good question. The sources highlight a built-in protection for that. If you hold the TIPS bond all the way to its maturity date, you're guaranteed to get back at least your original principal amount. So even if deflation pushed the adjusted value down to, say, $980, you'd still get your $1,000 back. You get the higher of the adjusted principal or the original principal.
Oh, okay. So that deflation protection applies specifically at maturity and protects your initial investment amount. That's key.
It is. It protects against losing your starting capital due to deflation if you hold to the end.
And what kind of time frames are we talking about? How long are these bonds issued for?
The Treasury issues them in 5, 10, and 30-year terms, so you have some choice depending on how long you want to invest for.
And just to be crystal clear, how is this different from a regular, plain vanilla treasury bond that they call a nominal treasury?
Big difference. A nominal treasury has a fixed principal, say $1,000, and pays a fixed interest rate on that $1,000 for its entire life.
Okay.
If inflation takes off during that time, the buying power of those fixed interest payments and the final $1,000 you get back shrinks. It buys less. TIPS are explicitly built to counteract that erosion. The adjustment mechanism is the whole point.
Got it. Okay, that makes sense for the individual bond. Now let's layer on the ETF part. What exactly is a TIPS ETF, and why would someone use that instead?
Right. So a TIPS ETF is basically a fund. It pools money from lots of investors and uses that money to buy a whole collection, a basket of individual TIPS bonds. Often, these ETFs try to track a specific index, like the Bloomberg Barclays US TIPS index mentioned in the sources, which gives you broad exposure.
And the main difference for the investor is how you actually buy it.
That's a huge part of it. Instead of going through Treasury Direct or the sometimes less liquid secondary market for individual bonds, you buy and sell shares of the ETF, just like a stock, on a major stock exchange through your regular brokerage account. Super easy, super accessible.
So the fund company bundles up all these TIPS bonds, and I just buy a tiny piece of that bundle by buying an ETF share.
Pretty much. Brokers and the ETF provider handle the creation and redemption of ETF shares, usually by swapping baskets of the actual TIPS bonds. The ETF's price on the exchange tracks the value of all those underlying bonds. It holds the net asset value, or NAV.
So if the TIPS and the fund go up because of inflation adjustments, the ETF value should go up too.
Generally, yes. The NAV reflects the value of the holdings. The goal is just to give you easy access to the performance of the TIPS market in one shot.
Simple, convenient access.
That's the main selling point.
Okay, definitions down. Now the big question, do they actually work? How do TIPS ETFs really fight rising prices for you?
Well, the main weapon, the core mechanism, is that direct link we talked about, the principal adjusting with the CPI.
Right.
As inflation goes up, the value of the TIPS bonds held by the ETF goes up. That increase flows through to the ETF's net asset value. So in theory, the value of your investment moves roughly in line with inflation.
Okay, that's the direct principal link. What about yield? People talk about real yield with TIPS.
Yeah, that's important. The yield quoted on a TIPS bond is its real yield. It's the return you expect to get after inflation is factored out. It's your gain in actual purchasing power.
Unlike a normal bond yield, which is just nominal, doesn't account for inflation eating away at it.
Exactly. And there's this interesting connection between TIPS yields and regular Treasury yields.
Oh, yeah. What's that?
The difference in yield between a nominal Treasury bond and a TIPS bond of the same maturity, that gap, that spread, it basically represents the market's collective guess about what inflation will average over that period.
Ah, the break-even inflation rate.
Precisely. It's the inflation rate at which you'd be indifferent between holding the TIPS or the nominal Treasury. It reflects the market's inflation expectations.
And the sources had some chatter about where TIPS real yields are now, or were recently.
They did. Some of the online discussions we looked at noted that recent real yields, as of June 2024, were well above 2%.
Is that good?
Well, some folks in those forums definitely thought so. They described it as attractive, even pretty cheap compared to historical levels. There was a feeling like, hey, this is something worth looking into, especially if you're getting closer to retirement and really focused on that purchasing power.
So a sense that maybe it's a decent entry point based on history?
That was the sentiment from some, though someone else pointed out that yields were way higher, like 4% on the 30-year TIPS back in the late 90s.
Wow, 4% real.
Yeah, but they sort of dismissed that as an anomaly, saying TIPS were this new, relatively unknown product back then. The implication being don't expect those kinds of yields now that the market's mature.
Okay, interesting context. Beyond just the inflation link and the yield, how do TIPS ETFs fit into a bigger picture, like a diversified portfolio?
Diversification is a really key potential benefit that came up in the sources. They noted that TIPS tend to have a low correlation with stocks and also with regular nominal bonds.
Meaning they don't always move in the same direction at the same time.
Exactly. When your stocks are down, or maybe your traditional bonds are getting hammered, especially if it's because of inflation fears, TIPS might be doing something different. They could zig when other things zag.
So they could potentially cushion the blow in certain market conditions.
That's the hope. Their performance is driven more by inflation expectations and real interest rates, not so much corporate earnings like stocks or nominal rates like traditional bonds, so they react differently.
And the sources contrasted this with something like corporate bonds.
Yeah, one comment noted that some investors avoid corporate bonds if they're really looking for diversification because corporates tend to be highly correlated with the market, meaning stocks, they often move together. So TPS offer a different kind of diversification benefit specifically against inflation risk.
That makes sense. If you want parts of your portfolio to behave differently, especially when inflation is the worry, TPS are designed for that specific job.
Right. They tackle that particular risk head on.
Okay, so we understand what they are, how they aim to work. But you mentioned you can buy the individual bonds. Let's really break down that choice. ETF versus buying direct. What are the trade-offs?
This is crucial because the ETF route offers a lot of convenience, but it's not free, and it's different from holding the bonds yourself.
Let's start with just getting your hands on them. Buying and selling. Accessibility.
ETFs are super easy here. Buy and sell them anytime the market's open, just like a stock, through your broker. Generally very liquid, easy to get in and out at the current market price.
And the individual TPS bonds.
You can buy new issues direct from the government at treasurydirect.gov, no commission, or through brokers, usually at auction times. Selling them before maturity means using the secondary market. And that market, while it exists, is generally seen as less liquid than the big ETFs. Might be harder to sell quickly at the price you want.
Okay, less liquid. What about minimums? How much do you need to start?
ETFs usually win for smaller amounts. You can often buy just one share. And with fractional shares now, you might start with, $50 or whatever the share price is, maybe even less.
And individual tip.
The minimum is $100, and you buy in increments of $100. So a slightly higher hurdle to get started or add small amounts.
Diversification is another big one you mentioned for ETFs.
Huge difference. One ETF share gives you instant ownership of a whole basket of tips, often with different maturity dates. You're diversified across the TPS market segment the ETF tracks right away.
Whereas if I buy one individual TPS bond,
You just own that one bond with its specific maturity date. If you want diversification across maturities, you have to build your own TPS ladder, buy bonds maturing in different years. That takes more work, more management.
how about the income they generate?
ETFs usually pay out dividends more often, typically monthly. These payments bundle up the interest from all the underlying bonds, plus maybe some capital gains the fund realized. Though, one source warned, if there's deflation, the ETF might not pay out that month.
Okay, monthly cash flow potentially. And the individual bonds.
They pay interest just twice a year, semi-annually.
Right. Now, the big trade-off, costs. This is where the ETF convenience isn't free.
Exactly. ETFs charge an ongoing management fee, the expense ratio. It's an annual percentage taken out of the fund's assets to cover costs. And they vary. The sources gave examples like VTIP of Vanguard short-term TPS ETF, really low at 0.03%.
Yeah, that's tiny.
It is. But then TIP, the big iShares TPS ETF, is higher at 0.18%. And some actively managed ones could be over 1%. That fee eats directly into your return year after year.
And if I buy the individual TPS directly from the Treasury?
No ongoing management fee, zero. If you buy through a broker, maybe a one-time commission, but not that annual percentage drain.
So convenience, liquidity, instant diversification with ETF versus potentially lower costs, especially over the long run, with direct ownership.
That's the core trade-off. For someone investing smaller amounts or someone who really values being able to trade easily, that ETF expense ratio might seem worth it for the simplicity.
Any difference in how their prices behave day to day?
Yeah, a bit. ETFs trade on the exchange, and their market price can wobble slightly above or below the actual value of the bonds they hold the NAV. Little premiums or discounts based on supply and demand for the ETF shares.
Okay.
Individual TPS, if you buy at auction, start at par value. If you sell them later on the secondary market, their price will fluctuate based on current interest rates and inflation views, just like any bond.
And managing them. ETF is hands-off.
Pretty much. The ETF provider's team manages the portfolio, buying, selling, handling the bonds. If you own individual tips, you're the manager. You track maturities, decide when to reinvest, keep the records. It's more DIY.
Okay, that really clarifies the ETF versus direct bond decision. But no investment is perfect. Let's dig into the catches, the risks, the downsides of TPS ETFs that the sources pointed out.
Right. We mentioned the expense ratio already. That's a clear cost drag compared to direct ownership. But there's more.
Like tracking error. What's that about?
Tracking error is basically the ETF not perfectly matching the performance of its benchmark index. It might lag slightly or sometimes even outperform slightly, but it's not a perfect mirror image.
Why does that happen?
Several reasons came up. Maybe the ETF uses sampling, holding only some of the bonds in a really big index, not all of them. Transaction costs inside the fund matter. Big money flows in or out can cause temporary dislocations. Or if it's an actively managed fund, the manager's choices might differ from the index. It just means your return might not be exactly what the index did.
Okay, bit of potential slippage there. What about liquidity mismatches? You said the ETFs are liquid, but the underlying bonds might not be.
This was an interesting point, especially about crisis periods. The ETF shares themselves usually trade very easily on the stock exchange, but the actual market for some of the individual TPS bonds inside the ETF can sometimes dry up or become less liquid, especially when markets get stressed.
And how does that affect me as an ETF holder?
It can make the ETF manager's job harder. If lots of people are selling the ETF, the manager might have trouble selling the underlying bonds quickly or at a good price to raise cash. This could impact the ETF's price, maybe causing it to trade at a wider discount to its NAV. One source specifically mentioned TPS behaving very strangely during a crisis, like in 2008-09, and again more recently in 2021-23.
Strangely how?
Like you'd think a safe government bond would be a flight to safety asset people buy in a panic. But the source suggested that because of these liquidity concerns, the market didn't always treat them that way. They actually saw significant price volatility drops during times of stress.
Wow. So the government backing guarantees the payment eventually, but doesn't guarantee the market price will be stable, especially when things get hairy.
Exactly. Market mechanics and liquidity can still create short-term volatility, even for safe assets. It's a reminder that safe doesn't mean static.
Okay, that's a crucial nuance. Now, let's hit the big one, the one that probably shocked a lot of people. Interest rate risk. How can an inflation-protected investment lose value when inflation is high?
This is so important to understand, and the sources were really clear on it. TPS ETFs are still bond funds. And what happens to bonds when interest rates go up?
Their prices usually go down because new bonds are being issued with higher rates, making the old, lower-rate bonds less attractive.
Bingo. And that applies to TPS too. Even though the inflation adjustment is boosting the principal value, if overall market interest rates are rising even faster, the market price someone is willing to pay for that existing TPS bond can still fall.
So the interest rate effect can overwhelm the inflation adjustment effect on the market price.
Absolutely. And the prime example hammered home in the sources was 2022. Inflation was soaring, highest in decades.
You'd think TPS ETFs would be winners, right?
Yeah, logically. But what else was happening? The Fed was jacking up interest rates super aggressively to fight that inflation. And because rates rose so sharply, the market value of all existing bonds, including TIPS, took a nosedive. One source said TIPS and TIPS ETFs fell, on average, 14.2% in 2022.
Whoa. Down over 14% in a year with massive inflation? That feels totally upside down.
It felt that way to a lot of investors. The sources pointed out they performed not much better than regular treasuries or even stocks that year. The big lesson was TIPS are bonds at the end of the day, and bond markets react badly to rise in interest rates.
So they protect against the long-term erosion of purchasing power through those adjustments, but they are not immune to short-term market price drops caused by rising rates.
Precisely. The market price before maturity is still heavily influenced by what's happening with overall interest rates and real yields. The sources even noted they struggled into 2023 and early 2024 as the rate situation evolved.
Okay, that 2022 example makes the interest rate risk crystal clear. Now let's shift to another tricky area. Taxes. Specifically this tax drag or phantom income thing.
Right. This is a big deal, especially if you hold TPS outside of a retirement account, like in a regular brokerage account. For an individual TPS bond, remember that inflation adjustment that increases the principal.
Yeah.
The IRS considers that increase to be taxable income in the year the adjustment happens.
Wait a minute. You pay federal income tax on that principal increase now, even though you don't actually get that extra principal cash until the bond matures, maybe years down the road, or until you sell it.
Exactly. That's why they call it phantom income. You owe taxes this year on income you haven't actually received in cash yet. You might have to dip into other funds to pay that tax bill. It creates drag.
Okay, that sounds potentially annoying. How does it work with TPS ETFs? Same problem.
It's a bit different, according to the sources, but still a tax issue. With TPS ETFs, the fund structure usually pays out those inflation adjustments to you, the shareholder. They typically get included in the regular dividend distributions, often monthly.
So with the ETF, I do get the cash related to the inflation bump. It's not phantom in that sense.
Correct. One source called it real income because you received the distribution. But that distribution, including the portion from the inflation adjustments, is still federally taxable income in the year you receive it.
Okay, so no phantom cash issue, but still an annual federal tax hit on those inflation adjustments as they're distributed.
Yes. It still creates a potential tax drag on after-tax returns in a taxable account. You're paying taxes each year on that inflation-linked component. Now, the sources do point out a silver lining. This income is generally exempt from state and local income taxes.
Oh, that's good to know. So federal tax applies annually on the distributions, including inflation adjustments, but usually no state or local tax. Still something to be aware of for tax planning.
Definitely. It makes a difference where you decide to hold these things.
Okay, considering all of that, the mechanics, the pros, the cons, the risks, the taxes, who are these TIPS ETFs really for? Who's the target audience, according to the sources?
The material points to a few key groups.
Like who?
First up, conservative investors. People whose main goal is preserving the buying power of their capital, minimizing risk. The government backing provides credit safety, and the inflation adjustment aims to protect the value. Then, retirees or folks needing income. The potential for those inflation-adjusted interest payments from bonds or dividends from ETFs is attractive if you're living off your investments. Your income stream might grow with the cost of living. One source even mentioned tools to calculate sustainable withdrawal rates using TIPS.
Yeah, that inflation-linked income potential seems huge for retirees worried about rising costs.
It really is. Also, long-term investors who are specifically worried about inflation over many years, these aren't really meant for short-term trading on inflation spikes. They're designed for the long haul, fighting that gradual erosion of purchasing power. And as we just discussed, investors in high state and local income tax areas might find the tax exemption on the income appealing, even with the federal tax.
Makes sense.
Yeah.
Any others?
Institutional investors, like pension funds or insurance companies, use them heavily. They have long-term obligations often tied to inflation, so TIPS help them match those liabilities.
Right. And finally, back to the convenience point.
Absolutely. Anyone who strongly values the convenience, instant diversification, low minimums, and high liquidity of the ETF structure might prefer it over buying individual bonds, even with the expense ratio.
So if you fit one or more of those profiles and appreciate the ease of the ETF, it could be a match.
That seems to be the conclusion from the sources.
Now, taxes came up a lot, and you mentioned one source went really deep. Let's circle back to that, especially this really interesting, maybe controversial point about substantially identical ETFs and tax loss harvesting.
Yeah, this is where things get complex, and according to the sources, operate in a bit of a regulatory gray area. It goes beyond the basic tax rules for ETFs.
Okay, first, just remind us of the standard tax rules when you sell an ETF.
Sure. Sell for a profit. Capital gains tax. Hold less than a year. It's short-term gain. Tax at your higher ordinary income rate. Hold more than a year. It's long-term gain. Taxed at lower rates, generally 0%, 15%, or 20% federally. Plus maybe that 3.8% net investment income tax if your income is high.
And if you sell at a loss?
Capital loss. You can use that loss to offset capital gains. If you have more losses than gains, you can deduct up to $3,000 of the excess loss against your ordinary income each year, carrying forward any remainder.
Okay, and that leads to tax loss harvesting, selling losers to cut your tax bill.
Right, it's a standard strategy. Sell something that's down, capture the loss on your tax return to offset gains or income, potentially lowering your taxes.
But there's a catch, the wash sale rule.
Exactly. The IRS rule says you can't claim that loss for tax purposes if you buy back the same security or one that's substantially identical within 30 days before or 30 days after the sale.
The idea being you can't just sell IBM stock for a loss on Monday and buy it right back on Tuesday just to get the tax break without actually changing your investment position.
Precisely. You have to stay out of that specific investment for over 30 days or buy something different enough.
And this substantially identical definition is where the ETF situation gets murky, according to the sources.
That's the core of the debate described. First, the sources note ETFs are generally very tax efficient internally because of how they handle creations and redemptions with in-kind transfers of securities. They tend to distribute fewer capital gains than traditional mutual funds.
Okay, good for the fund holder. But the debate is about investors selling the ETF shares.
Yes, it's clear. Sell Vanguard's S&P 500 ETF, VOO, at a loss and buy VOO back next week. That's a wash sale, loss denied. But The sources highlight this practice and a reported lack of strong IRS pushback where someone sells, say, VO at a loss
Yeah.
and immediately buys shares of, say, iShares S&P 500 ETF, IVV, a different ticker, different fund company, but tracking the exact same index, often with near-perfect correlation like 99% plus mentioned in one study.
So are those two different ETFs considered substantially identical?
That's the billion-dollar question, or maybe the $30 billion question, as one source estimated the potential annual tax revenue impact. Legally, it's debated. Practically, the sources suggest many investors and advisors operate as if they are not substantially identical for wash sale purposes, allowing them to harvest the loss while maintaining virtually the same market exposure.
And there was a specific example cited.
Yes, the sources detailed the Brian Acton case from the ProPublica report. According to those tax records, he sold a Vanguard Emerging Markets ETF at a loss, bought a BlackRock Emerging Markets ETF the same day, claimed the loss, and later did the reverse, effectively swapping between highly similar ETFs to generate tax losses without being out of the market.
And the source suggests this isn't just a one-off, but pretty common.
The study cited estimated it accounted for a significant chunk of trading volume in some ETFs, maybe 9% of AUM volume overall, or over 20% in these highly correlated pairs. The study's author called it a regulatory gray area and essentially a subsidy to ETF traders, urging regulators to clarify the rules, maybe changing identical to similar.
So it's a known strategy, potentially exploiting ambiguity. Seems to be happening widely, but exists in this uncertain regulatory space.
That's the picture painted. We're just relaying what the sources reported on this complex and debated practice.
Fascinating stuff. Okay, moving away from that specific debate, what about more standard, clearly acceptable tax strategies with ETFs?
Well, the basic stuff always applies. Try to hold winners for over a year to get lower long-term capital gains rates. If you have losers, maybe sell before a year to get the potentially more valuable short-term loss against ordinary income up to the limit. Another approach mentioned is maybe less controversial. Sell a losing individual stock or a narrow sector ETF, realize the loss, and immediately buy a broader index ETF that includes that sector or stock. You maintain market exposure, but swap into something clearly not substantially identical, harvesting the loss while staying invested.
That sounds more straightforward. And the absolute easiest way to deal with the annual tax issues from TIPS's ETFs, like those inflation adjustments.
Put them in the right type of account. The sources strongly recommend holding investments like TIPS ETFs or individual TIPS bought via a broker inside tax-advantaged accounts, traditional IRAs, Roth IRAs, 401ks, etc.
Why did that help so much?
Because inside those accounts, you generally don't pay taxes year to year on the income, dividends, inflation adjustments, or capital gains generated. Everything compounds tax deferred, like in a traditional IRA 401k, or potentially tax-free, like in a Roth. You only pay taxes when you withdraw money in retirement, or not at all, for qualified Roth withdrawals.
So that whole phantom income or annual tax drag from inflation adjustments just disappears inside a retirement account.
Completely avoided until withdrawal. It lets the inflation protection compound much more effectively over the long term without that yearly tax friction.
That seems like a no-brainer for long-term holdings if you have the space in those accounts.
It definitely simplifies things and boosts the after-tax return potential.
Okay, great advice. Now, if someone is considering a TIPS ETF, maybe for their IRA, how do they pick which one? You said there are nearly 20. What should they look for?
Yeah, choosing isn't trivial. The sources highlighted several key factors to compare.
What's factor number one?
Expense ratio. Got to check the fee. Lower is better, all else equal. We saw examples from 0.03% to 0.18% and higher. That difference really adds up over time.
Makes sense. What's next?
Liquidity. How easily can you trade it? Look at average daily trading volume and the bid-ask spread, the difference between buying and selling prices. High volume and a tight spread mean lower transaction costs. SCHP was cited as very liquid, CPII is less so, important if you trade often or in large size.
Okay, cost and trading ease. What else?
Duration. This is huge for TIPS ETFs because of that interest rate risk we discussed. Duration measures sensitivity to rate changes. Short-term ETFs like VTIP or SDI have low durations, around 2.5 years in the examples, so their prices move less when rates change. Longer-term ones like SPIP, around 7 years, or LTPZ, much longer, are way more sensitive.
So you pick a duration based on how much interest rate risk you're willing to take.
Exactly, and your time horizon. Shorter duration generally means less price volatility from rate changes.
Got it. What else matters?
Tracking error. How well does it actually follow its index? Lower error is usually better. And maybe diversification within the fund. How many bonds does it hold? SPIP at 55, DFIP had 17 in the examples. Might reflect slightly different strategies or index coverage.
So it's really about matching the ETF's specific characteristics, cost, liquidity, duration, tracking to your own needs, and risk tolerance.
Precisely. There's no single best TIPS ETF. The best one is the one that fits your goals. The sources mention some popular tickers like TIP, VTIP, SCHP, SDHP to start research, and noted Vanguard has multiple options too. VTIP, the ETF, but also mutual funds like VIPX, and others mentioned VIPSX, VTIPX. Correction check, yes, the source listed VIPSX, VTTX, VIPX as Vanguard options. Keep these specific codes.
Good to know there are mutual fund versions too. Okay, this is clearly complex. Choosing from 20 options, understanding duration risk, navigating taxes.
Yeah.
It feels like a lot for the average person. This seems to lead naturally to the role of a financial advisor, which one source discussed.
It really does. I mean, nearly 20 TIPS ETFs alone and over 3,500 ETFs total in the U.S. It's overwhelming. The source laid out how an advisor can really help cut through that complexity.
How specific?
First, personalized guidance. They take your specific situation goals, risk tolerance, time horizon, and help figure out if TIP ETFs even make sense for you, and if so, which ones and how much. It's tailored advice, not generic. Second, expertise in risk management. They can look at how adding a TIPS ETF impacts your whole portfolio's risk profile, using tools and analysis, maybe even AI, the source mentioned, to manage correlations and volatility. It's about the big picture. Third, analyzing costs. They can help you understand not just the expense ratio, but trading costs, bid-ask spreads, and suggest ways to trade efficiently, maybe using limit orders or block trades if needed. Fourth, due diligence. Checking out the fund companies, the managers, their track records, though past performance isn't predictive, it's still info. It's an extra layer of scrutiny. And fifth, maybe the most important, behavioral coaching. Keeping you disciplined during market swings, preventing panic selling or chasing hot trends, helping you stick to your long-term plan when emotions run high.
That emotional buffer, that objective voice, seems incredibly valuable. It can save people from making huge mistakes.
It really can. And finally, just saving you time. All the research, tracking, rebalancing. It takes effort. An advisor handles that, freeing you up.
So for people feeling lost in the ETF jungle or worried about making mistakes, an advisor can be a guide to using tools like TIPS ETFs effectively.
That's how the source positioned it, maximizing benefits, navigating complexities with professional help.
Wow. Okay, that was definitely a deep dive. We covered a ton on TIPS ETFs.
We really did. Started with the basics. Government bonds, principal adjusts with CPI, pays interest on that adjusted amount, deflation protection at maturity.
Then saw how ETFs package them up for easy access. Direct inflation link, potential diversification, convenience, liquidity, low minimums, all the pluses.
But then the crucial caveats. The costs, expense ratios, tracking error, liquidity issues and crises, and that big one, interest rate risk. 2022 showed they can lose market value even with high inflation if rates rise fast enough. They aren't a perfect short-term shield.
Plus the tax complexities. That annual tax drag in taxable accounts and that whole fascinating, maybe murky area around tax loss harvesting with similar ETFs.
Putting it all together, the sources suggest they fit best for long-termers focused on preserving buying power, retirees needing inflation-linked income, maybe those benefiting from the state-local tax break, people who value the ETF fees despite the costs and understand the risks.
And we finished by seeing how an advisor can help navigate all of this, choosing the right ETF, managing risk, dealing with taxes, and staying disciplined.
You know, it leaves you with a thought, doesn't it? In this world of ever more sophisticated financial products, complex strategies, and sometimes ambiguous regulations, how do you, as an investor, really figure out your true bottom line return?
Meaning after all the costs, all the taxes are accounted for.
Yeah, after costs, after taxes, after considering the impact of these complex strategies that might operate in gray areas, what's the real net benefit you're getting? It's something worth pondering as you build and manage your own portfolio.
Definitely food for thought. A great place to wrap up our deep dive for today.
Absolutely.